All right, welcome to the Explainer. Today, we're diving into a word that can make a lot of business owners a little nervous, but it's actually one of your most powerful tools, depreciation. Seriously, getting this right can save you a ton of money on your taxes, and we're going to break it all down, step by step.
Okay, picture this. You just made a big purchase for your business. Maybe it's that shiny new work truck you've been needing, or a whole suite of new computers for the team. You know it's a legit expense, but can you really just write off the entire thing on this year's taxes? Or maybe you can.
Well, the IRS definitely has a plan for it, and that plan is called depreciation. And look, this isn't just some boring rule you have to follow. It's actually a system you can leverage to significantly lower your tax bill and make much smarter financial decisions for your business.
So, here's how we're going to break it all down. First, we'll cover what depreciation actually is. Then, we'll look at the different paths you can take. After that, the fun stuff, the big accelerators. We'll also cover some special rules to watch out for. And finally, what happens when it's time to sell that asset. Ready? Let's jump in.
All right, first up, what exactly is business depreciation?
Okay, so at its most basic level, depreciation is how you recover the cost of a big business purchase over time. It's kind of like this. Instead of taking one giant tax deduction in the year you buy something, the IRS has you slice up that single large expense into a series of smaller annual tax deductions over that asset's useful life.
Okay, Section 2, choosing your path. This is where the strategy really begins, because you have to decide how you're going to depreciate your stuff.
So you get to a fork in the road, and you've got two main options. The default, the one most people take, is the General Depreciation System, or GDS. Think of this as the fast lane. It lets you take bigger deductions in the early years. Then you've got the Alternative Depreciation System, ADS. This is the scenic route, slower, steadier, with the deductions spread out evenly. Sometimes you're forced to take this path, but other times you might choose it.
So how long do you get to depreciate something? Well, the IRS has pretty much decided that for you. It's called the recovery period. So you'll see things like, computers, tech, light trucks. Those are usually 5 years. Office furniture, machinery, that's typically 7 years. And then you get to the big stuff like commercial real estate, which is stretched all the way out to 39 years.
And one last piece of the puzzle here, these things called conventions. Basically, they're the starting rules for your first year. The default is called the half-year convention. So with that rule, it doesn't matter if you bought that truck in January or November. The IRS just says, hey, we'll treat it like you bought it on July 1st. So you only get half a year's worth of depreciation in year one.
Okay, so we've covered the normal ways to do this. But now, let's get to the exciting part, the big accelerators. Think of Section 179 and bonus depreciation as the turbo buttons for your tax savings, letting you potentially write off the entire cost of something in the very first year.
First up, the powerhouse, Section 179. Instead of spreading out the deduction, this lets you expense the whole thing right away. And for 2023, that limit is a massive $1.16 million. I mean, this is an absolute game changer for businesses buying a lot of equipment.
But, and this is a really big but, there's a key rule. Your Section 179 deduction can't be more than your business's taxable income. So what does that mean? It means you can use it to wipe out your taxable profits, bring them right down to zero. But you can't use it to create or increase a business loss. It's designed for profitable businesses.
All right, next up we have its powerful cousin, bonus depreciation. And the huge difference here, bonus depreciation can create a loss. There's no income limit. Now, for a long time, this was a 100% write-off, which was incredible. But you got to be aware that benefit is phasing down. It was 80% in 2023, it's dropping to 60% in 2024, and it's just going to keep going down from there.
So with these two powerful tools, how do you use them together? Well, the order of operations is absolutely critical. First, you hit it with Section 179, ideally to zero out your income. Then you apply bonus depreciation to what's left. And if there's anything left over after all that, that's when you use your regular year-by-year depreciation.
Okay, Section 4. Let's talk about some special rules, or maybe the tripwires you need to watch out for. See, the IRS gets a little suspicious when it comes to stuff you could use for business and for personal fun. Like cars, laptops, that kind of thing.
And this is the big one, the 50% business use rule. It's simple, but it's so important. To use those fast depreciation methods and to use Section 179 at all, you must use the asset more than 50% for business. If your business use ever drops to 50% or less, bam, You're knocked off the fast track and forced onto that slow ADS method. And even worse, you might have to pay back some of those sweet accelerated deductions you already took.
And speaking of cars, things get even more specific. You know, the IRS knows someone might be tempted to buy a luxury sports car and try to write the whole thing off as a business expense. So to prevent that, they created Section 280F, which puts strict annual caps on how much you can deduct for cars that weigh less than 6,000 pounds.
And yeah, these caps are pretty strict. No matter what the math says your depreciation should be, you can't go over the annual limit. But there is a silver lining. You can get an extra $8,000 bump in that first year if you take bonus depreciation. So that does give you a nice initial boost.
Ah, but now for the big one, the famous heavy vehicle exception you always hear about. Those luxury auto limits? They do not apply to trucks, vans, and SUVs that have a gross vehicle weight rating over 6,000 pounds. This is exactly why you see so many businesses buying heavy SUVs and trucks. They can sidestep those caps and potentially write off the entire cost in year one using Section 179.
All right, last section. What happens down the road when you sell that asset? You've been taking deductions for years. You sell the truck and you make a profit. That's just a capital gain, right? Well, not quite. We need to talk about something called recapture.
It's called depreciation recapture. And here's the deal. Every dollar of depreciation you took lowered your cost basis in that asset. When you sell it for a gain, the IRS looks at how much of that gain is just from the depreciation deductions you took. That amount gets recaptured and taxed at your regular ordinary income tax rate, not the better capital gains rate. Basically, the IRS is getting its tax benefit back.
Okay, so let's put it all together in a final checklist. First, you got to choose your system, usually GDS. Then, find the asset's class life. Is it 5 years, 7 years? Next, select your method. Then, figure out the right convention, probably half year. And then come the big guns. You apply Section 179, and after that, you apply bonus depreciation to what's left. That's the flow.
And that really brings us to the final and maybe the most important strategic question of all. Yeah, taking the biggest possible deduction right now feels great. It lowers this year's tax bill. But is it always the smartest move for your business in the long run? Think about it. If you expect your income to be way higher in a few years, pushing you into a higher tax bracket, wouldn't a big deduction be more valuable then? It's a strategic choice. It's not just about following the rules. It's about making the rules work for your long-term plan.